We are witnessing a never-seen-before breakdown in the relationship between gold prices and real interest rates on US Treasuries, an alarming signal that we could be on the verge of a major global economic event happening. Throughout history, gold and government bonds have been considered safe assets for investors to park their money, and the prices of both assets have risen together. As gold prices have gone up, bond prices have historically also gone up, meaning that as shown on this chart by an inverted axis, real rates on these bonds have declined. Since 2022 though, this relationship has started to break, and the gap in the decoupling between these two metrics has been growing and growing recently, as we have seen gold prices surge even higher, while real rates have also increased. In other words, US Treasuries are becoming cheaper and cheaper, offering a better real rate of return. However, investors are no longer buying these US Treasuries and are instead continuing to flock to gold, buying more and more of it. This unprecedented disconnect between these two metrics is very concerning market behaviour, because it does suggest that investors are preparing for the endgame. And we're not just talking about institutions, funds and individual investors here, we're talking about the largest market participants, such as central banks from countries across the globe. With central banks driving up the price of gold, this could also mean that they are preparing for a major currency devaluation event to happen, which could shock global markets. Bloomberg's Garfield Reynolds pointed out that the last two times when gold spiked to record highs were times of negative real yields, during the pandemic and in 2011 to 2012, when Europe's sovereign debt woes followed on from the global financial crisis. Reynolds adds, this may signal that investors are becoming worried that major turmoil is coming, or at the very least investors are hedging against currency debasements. We have seen a number of central banks adding to their gold holdings too, which only supports this view, and this includes China, who have been aggressively buying gold and other precious metals like copper for 17 straight months now, seeing their holdings rise by 16% over this period. Alexander Stahl, founder and chairman of Berggraben Holdings, notes that there are massive unreported gold purchases from central banks, mostly attributed to the People's Bank of China, and that the timing of this correlates with G7 sanctions on US Treasuries held by the Bank of Russia. He also notes that gold reserves do not carry US counterparty risk, and that geopolitics does matter. China, along with other central banks across the world, are trying to reduce their reliance on the US dollar, but this recent aggressive buying of gold and copper, from China specifically, also raises questions about what they might be preparing for. This buying behaviour is that of a country that believes a major currency devaluation could be coming, meaning that there is a chance that China is planning something major. We know that tensions have been rising between China and Taiwan, and also the US as well, and with all of the other global conflicts that are going on in the world right now, it does make you wonder what could happen in the future. We have seen JP Morgan CEO Jamie Dimon, in his most recent letter to shareholders, warn that we are entering one of the most treacherous geopolitical eras since World War II. And he does add to this that the impacts of the geopolitical and economic forces are large and somewhat unprecedented, and they may not be fully understood until they have completely played out over multiple years. There are big currency concerns closer to home in the United States as well, however, and there is good reason for investors to believe a dollar debasement could be coming, as there are many economic metrics that are looking very concerning. Government debt as a percentage of GDP has surged over the last several years to now being at approximately 100%, which is just below the all-time high that was seen back in the post-World War II era in 1945. And more concerningly, continuing under current government policies, the Congressional Budget Office does forecast that this debt-to-GDP ratio will continue to surge over the next few decades, doubling to 200% by the year 2053. The federal budget has historically oscillated between a small surplus and a small deficit every year, with the average deficit year being around 2 or 3% of GDP, but never more than 5% of GDP. In recent years, this budget deficit has slowly started to get larger and more out of control, with all of the budgets from the last 4 years being in a deficit of more than 5% of GDP. The CBO predicts that this is going to be the new norm, and in fact budget deficits will continue to get bigger over the next 30 years, reaching 8.5% by the year 2054. Now, the scariest thing about this rising government debt and widening budget deficit is that it has largely been taking place through a prosperous time for the US economy. Jamie Dimon mentions this too, writing, "The deficits today are even larger and occurring in boom times, not as a result of a recession." And perhaps the most concerning of all of the government's woes is the expenditure that they are paying on interest payments that has now surged to over $1 trillion annually as a result of this rising debt and elevated interest rates, roughly double the size of their payments pre-pandemic, which was in the $500 billion range. And according to Bank of America, these annual government interest payments will rise from $1 trillion to $1.2 trillion in April 2025, even if we see 150 basis points of rate cuts by the Fed. But alternatively, if we actually don't see any rate cuts at all between now and April 2025, these interest payments would rise to an astronomical $1.7 trillion, and this chart truly does show how parabolic and outright dangerous this rise in payments would be, which could push the government beyond a point of no return. These debt servicing costs now make up a whopping 12% share of government spending and are likely to rise even higher by the year 2025, according to OMB forecasts, pushing 14%. And part of the reason for this forecasted increase is the $8.9 trillion of government debt that is set to mature over the next year, which will be getting refinanced on a higher interest rate. And in fact, by the year 2052, the Congressional Budget Office does predict that debt servicing costs will grow as a share of total outlays to a massive 23%. This is a scary prediction because it is a sign of a government that has a spending addiction and is fueling future spending on more debt. Higher interest payments means borrowing more money to pay for this, which means even higher interest payments, and the cycle is never ending. And in fact, a Fed interest rate hike is not totally off the cards yet either, as all signs are now pointing towards stagflation, a nightmare situation for the Fed. As we note from the last few CPI readings, inflation has stayed stubborn, failing to fall below 3%, and is now back on the rise. And last week we got new GDP numbers coming in, showing that GDP growth slowed to just 1.6% in Q1 of 2024, less than half of the previous quarter in Q4 of 2023. And this was also roughly 50% below Goldman Sachs' expectations. At the same time, the US core PCE price index soared from 2% to 3.7%, higher than the 3.4% estimated figure, which further suggests that inflation is on the rise. This means that the economy is getting weaker while inflation is getting higher, putting the Fed in a terrible position. If they want to tackle inflation by leaving interest rates higher for longer, or even hiking them further, it's going to put more downwards pressure on GDP growth and the economy in general. While if they want to try and stimulate higher economic growth by cutting interest rates, then this is likely to lead to even higher inflation. And the current conflict in the Middle East could add even further to the Federal Reserve's woes, as it could be a major catalyst for soaring inflation in the back half of 2024, particularly due to rising commodity prices. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.